So with this chapter, we're jumping into compensation paid, the income distribution wise flowing back from the firm to the household for everything basically other than for wages. So we're focusing on rent, interest, and profits. Rent, of course, is paid to the household for the use of their land or for the mineral deposits on the land, so on and so forth, under the land, I should say. And at any rate, that's rent. Interest and profits are paid to the financial capital, meaning this would be for in terms of like the underlying part of physical capital is financial capital. And again, the financial capital comes in two forms: debt capital and equity capital. And debt capital is paid, think of like in terms of bonds, or if you have a savings account in a bank, the interest that you get from that, that would be the debt capital. And the equity capital would be flowing through to the household in the form of dividend payments and also in the form of um, uh, capital appreciation, meaning the increase in the value of the stock that you're holding, for example. Okay, capital gain. So also, that's just looking at the physical capital, drilling down on that. So if we look at it in terms of interest and profit, profit in particular, we drill down that. We've already talked about how physical capital is paid through this financial capital, paid for the owners of that physical capital and the holders or the owners of that financial capital. The other profits would include such things as profit flowing through to labor for, again, for the use of its labor, that's profit sharing, and also to the entrepreneur when we have what's termed stock options. And stock options, I've described it before, but basically it's just a situation where you guarantee if a CEO, for example, is hired in and in their contract, it stipulates that the current price of the share of stock, say, is $10. So in 3 years' time, you're going to be compensated again for your entrepreneurship. You may be getting a salary, but that's labor. But the entrepreneurship side would be the stock option, where they say, okay, we will sell you 1,000,000 shares of our stock at $10 in 3 years' time. So, of course, the objective is for you to increase the share value of the company, right? So, if you increase it up to $30 a share, you buy at $10 a share, so you pay $10 million for it, and you get right back what? 30 million. So you make $20 million in profit, if you will. And of course, if it doesn't go up over $10, you just never exercise your options, and chances are you won't last long as an entrepreneur. Anyway, opportunity costs, next best competitive option. Opportunity cost stresses that for anything you do, there are an array of options that you might have done instead, but cannot do since you've opted for the former. Again, that is your next best competitive advantage, right? So again, the firm wants to hire a resource, it must pay the owner of the resource the opportunity cost. So when we're talking in this case about rent, interest, and profit, the rent, we have to pay the land holders, the landowners, their opportunity cost level of compensation. Interest and profits, the same idea. So again, it's the reward sufficient to bring them from their next best competitive use. And we all operate under this premise. It's the thing that gets us going to work every day, keeps us at work every day. Work can be less than wonderful at times, right? And this is the thing that kind of gets you over the hump, that you will be getting that paycheck and you will be compensated for your efforts. You're covering your opportunity cost. And if you don't cover your opportunity cost, you seek employment elsewhere. Anyway, this also goes along the line of interest rates. Interest rates, again, are financial capital. Debt versus equity, this is the debt side interest rate. So if you're receiving 5% interest rate and other investments are earning 10%, what might cause that difference? So first off, you'd prefer to have the 10%, no doubt. But what is the difference between the two? what it often comes down to is risk. Are you willing to risk your investment? Meaning, are you willing to go that 10%? With the risk of maybe not getting your principal, meaning not being able to get that rate of interest. The people to whom you are lending the money may not be able to pay that interest, or they may not be able to pay back the debt at all, the principal. So this is the difference between interest rates. Really what it comes down to is risk is a major component. There are lots of different types of risk, but that's just it in general. So opportunity cost, when we talk about interest rates, you have to pay either the debt or an equity capitalist a reward sufficient enough to bring them from their next best competitive alternative. If not, you simply don't get them to invest. It's very, very straightforward. When everything is tallied up on one side in terms of how much of a risk you are, so on and so forth, how much risk that the actual lender can put up with, and so on and so forth. When whatever that interest rate that you arrive at, it embeds all of that risk. Similarly, when we talk about equities, equity would be stocks, right? So there's no guarantee. They go up and down all the time, and the ones that go up that swing more wildly, it's called the beta. So there's a lot of variance going up and down. Those tend to be more risky. There are different types of risk, and we'll get into that as we kind of go along. But anyways, you get the idea. Again, the compensation for that opportunity cost, for that higher risk is a higher opportunity cost. And from that flows that higher interest rate that you need. So in a broader sense, when we talk about finance, and this is what we're getting into here, finance has to do with cash flows. So we take your accounting or financial statements and we adjust, for the depreciation, accruals, and deferrals, push them back to a cash position, and then we extrapolate, which means that we're going to forecast, we're going to see what the future is going to look like, right? So we're guessing is really what it is. And we'll get into this in greater detail a little bit more toward the end of this, but one of the problems with guesswork is that it's just that. We really don't know what the future holds, and even if we depend upon past history, that is not always an indication that what will follow, correct? So this is crystal ball territory. We really don't know what's coming, especially when we're talking about a situation looking out, the further out in the future that we look. So the resources, when we talk about financial and human, the productive resource, labor, entrepreneurship, and capital land rather, the capital piece of that, of course, is plant and equipment, and we also have that the inventories of the firms themselves. So buying, we're looking at financing the purchase of capital, for example, financial capital. It comes in the form of, again, equity purchase or stock, or debt claims such as bonds. So this is pretty straightforward, and there are a lot of different variants on this, but I'll just explain one real quickly. So when you buy a share of stock, you're buying ownership in a company. What is the value of that stock? Well, it depends. Depends on what? Depends on that moment in time, because it changes all the time. Shares of stock prices, you can look them up online, and they're going up and down all the time. Of course, we'd like to have them go up all the time, but that's not always the case. There's fluctuation with equities for sure. Bonds are pretty straightforward. They're very explicit. The face of the bond indicates what the maturity, when you can get your principal back, for example. All this is explicit. It's there on the face of the bond. They used to be paper, and now they're all electronic, but still the same idea. Not just the maturity, the interest that's going to be paid, how that interest is going to be paid. Is it paid monthly, quarterly, annually? And the exact terms of the payment of that bond. So it's very, very explicit. There's more to it than that, but you get the idea. Financial capital is the underlying part of that physical capital, and two types of financial capital, again, equity capital and debt capital. So Human capital. We've talked about human capital before, but it could be education, training, conferences, workshops, certifications, anything that will help to make you more valuable to a given firm. And it's also determinative of your compensation. It goes back to your, the demand for resources that whole concept that we talked about before. And so different types of capital, the physical capital, the financial capital is the underlying part of that physical capital, as is human capital. And they're all interconnected, of course. So again, physical capital, financial capital, and the underlying part of financial capital is debt capital and equity capital. Yes, profits is a cost, right? In accounting, profit is very straightforward. It's revenue minus expense, and that is equal to your profit or your loss, your net income or your net loss. Profits as a cost is an economics concept. So it's often misunderstood, and it's especially when we're talking about productive resources. The idea is that the profits are reward for resource, in other words, our income, whether we're talking about income for the use of our labor, entrepreneurship, capital, or land, any of those, right? Or any or all of those, I should say. So we have to understand that income that you're receiving from the firm counts as what? A cost to the firm, right? Because really what a firm does, you're producing, so you're taking productive resources from the household, you're demanding them, you're converting those into useful goods and services. But what's entailed in all of that are what? Cost. So the firm is building up cost. They're building up the cost of the productive resources that they use, and they're also developing a cost structure, if you will, to compensate to compensate the household for, again, the use of those productive resources. And they're also building the cost of what they have to charge the household as consumer. And embedded in that cost, of course, is some profit, because they have to stay in business. They have to show some profit for whom? For the productive resources that are employed, for the labor, for profit sharing, for the entrepreneur, for the owners of that physical property, the financial capital. Hopefully you're starting to get a sense of where we're going with all this. So anyways, you have to pay equity capitalists sufficient funds to keep them investing, really is what it comes down to. You have to pay their opportunity costs to stop them from going elsewhere. You have to pay them enough to keep them engaged in the process, just the same as it is for labor. Again, the consequences for not paying the opportunity cost, the price to keep the investor satisfied, is that the firm will lose equity capitalists. Stock prices will drop accordingly, right? And on top of that, too, so far as the debt capital is concerned, if you're losing share price, it's going to impact the value of that company, which is going to increase the risk that's associated with what? With paying back the debt capital. So that then the bonds that you're issuing become more costly to the firm. Anyway, you get the idea. Profits, again, in an economic sense, are a cost, and it's easily kind of backed up walking through the process. So again, in economics, we're looking at the circular flow as household, as owners of the productive resources. So long as compensation just covers their opportunity cost, this is counted as normal profit. And again, it's included as cost to the firm, because who's paying the compensation? The firm is paying compensation to the household for all of those things, not just for the labor, but also for the profits that are associated with the financial capital, to the debt owners of the firm and also the equity owners of the firm. So again, just as an offshoot note, and we'll continue on with this shortly, and that is that accounting is an art of estimation. We don't necessarily think about that. We think of accounting as being precise, and it is, for the most part, hopefully. Very precise, very ordered, and so on and so forth. But the reality is it is estimation. The reason it's an estimation is because and if you've taken an accounting class, you'll understand this, hopefully. We're accounting for what? Depreciation. We're guessing how much the equipment that we have, how it's being used up, that capital that capital purchase, how it's being used up. That's reflected in the depreciation schedule. Accruals, we're accounting for for costs that we're going to be incurring in the future, expensed items that are going to be incurred in the future, deferrals, putting off these things, deferring them for a future period. And then the finance piece of this is where the economics comes in. We're actually estimating the future. So we're taking all those financial statements that are embedded in accounting, and we're taking it a step further by disaccruing, by taking out the depreciation and the deferrals and putting it on a cash basis, and then we're guessing what the cash basis will be down the road. Okay. So this is kind of a tough one for people to kind of get their head wrapped around. So I'd like to walk through it more than one occasion, or kind of a look at it in a different manner. The same idea, and that is when we talk about capital, financial capital. So when we distinguish between an equity capitalist, or the equity capitalist, the shareholder, the stockholder, and the debt capitalist, the bondholder, the reward for the debt capitalist is generally called interest, and the reward again for the stockholder would come in the form of dividends, etc., right? So explicitly, the interest is a contractual agreement that must be paid, or default is incurred, and legal actions can be taken against firms that fail to pay the interest on debt capital. On the other hand, when we turn to equity capitalists, the profits are paid out in dividends, but do not have to be paid in a contractual sense, in any contractual sense. So again, to put it very straightforward, in a very straightforward manner, the debt holder, like just look at a bond, for example. Again, it's very explicit. It points out on the face of the bond, again, electronically speaking, on the face of the bond, there's the maturity date, when the actual bond expires, or when it's all the contractually agreed upon terms are concluded, right? So there's the maturity date, 5 years, 10 years, what have you. Just like a loan, just think of it as a loan. And the terms of that loan or that bond would include the payments, the regular scheduled payments, or how it's paid back, all the terms associated with closing out, finishing up, concluding the business that's associated with that loan or that bond. On the other hand, when we talk about the equity side, the stockholder, shareholder, we don't know what the value of that is. It's not, there's no contractual statement, saying what is going to be paid in terms of like dividends, the profit that it would be shared, if you will, with that equity owner of the firm. The only thing that's guaranteed is that they have one share of stock, or whatever the number has a stipulated number of shares of stock that they purchase. So it's pretty straightforward. So going into finer detail, oftentimes people look at, they say, well, debt or bonds are safer than is equity, or bonds are, and in some sense, in some ways they are, but they all have the same, they're embedded with the same type of risks. Maybe not the same risk exactly, but they are embedded with the similar risks. So the risk premium is for both debt and equity. The owner, or the equity capitalist, is also the resource of the firm. Is a residual claimant, the last in line, so to speak. So they receive whatever is left over, and because of the status, the reward bears a significant risk. There's a greater reward, perhaps, but there is definitely more risk that would be embedded, all else equal, between an equity share in a company and a bondholder, for example. This means then that a risk premium must be paid to the equity capitalist to keep them in or with the firm, or to attract even more equity capital for growth. So there has to be some sort of compensation to cover their opportunity cost, right? So again, firms must pay the equity capitalist at a higher rate of return in general, in terms of the dividend and the capital gains. Remember The dividend is the profits that's shared, and the capital gain is the unrealized increase in the value of that stock. So you buy it for $10 and it goes up to $30, you have a capital gain of $20. The difference between what your purchase price was and what the value of that stock is, that's the capital gain. And it's only realized when you do what? When you liquidate, when you sell your position. Again, that is paid to, so there's a higher rate of return, generally speaking, that is paid to the debt capitalist, who is given a contractual guarantee what the payments are going to be, how the payments are structured, right? So it sounds pretty simple and everyone is somewhat familiar with this, but there is some theory that goes into this. And it's interesting, to kind of go through this. There's historical precedent so far as how interest came about. It was oftentimes in the past, in relatively ancient history, not that, 1,000 years ago or more, where there was quite an argument over whether or not paying interest was usury, was taking advantage of people, and it can be, but it's generally agreed upon. At least it seems to make sense to me that it's logical that interest would be paid, especially now in our current times. Not especially, but it makes more sense to us, I guess, today, in that we talk about it in terms of opportunity cost. So you are surrendering two things. One, you're surrendering what you could have purchased with your funds, and you're also surrendering the funds to someone else for a period of time. So there's a certain amount of risk that's embedded in that right from the start. Okay, anyway. The theory behind interest rates. The interest rates are the sum, again, paid to the lender, the debt capitalist, as a percent of the given base investment. How much interest is paid on that principal that's being borrowed, right? The interest rate, like a wage rate, like a foreign exchange rate, is a price. All of these are prices, whether we're talking about a pound of hamburger or dollars per hour, or the interest that you're paying on a loan, or receiving, being compensated for that loan. These are all prices. So it's a ratio of exchange. This is the time between units, this time between units of future money for units of present money, the present value of money, right? So there's this time value of money that enters into the equation as well. So we're looking at this not just in terms of the interest as it stands, but also when you're receiving that flow of payments going forward, how that's impacted in terms of the time value of money, the time spent away from your money, the inflation that might be occurring, right? So anyway, risk premium to debt, the risk premium of debt, of interest bearing securities and equity in terms of shares of stocks and bonds, shares of stock, in terms of, again, that the dividend that you're receiving and or the capital gain if you decide to exercise your rights and sell your share of stock. Anyway, so this is looking at just a real quick example. You have $100, 6% interest, then in 1 year's time you're going to be paid, this is a fairly straightforward, you're going to be paid $106. So if you borrowed it, you will pay $1.06, right? Excuse me. You will pay $106. At any rate, so going into that, the build up, if you will, for that interest rate, the risk that's associated with that results in a composite rate. So everything kind of comes together. So the way it builds up, and this is just an example, it could be for many, many different reasons, but the pure interest rate, that's the no risk, just that time preference, the time value of money, allowances for the following: financial uncertainty, any kind of preferential treatment so far as tax codes are concerned, so far as like debt instrument versus an equity instrument, the tax liability associated with it, the gain or loss of purchasing power, that's brought on by deflation would be the gain, inflation would be the loss of purchasing power. And when we take all the allowances, we arrive at what we refer to as that pure interest rate. If we take all those allowances out, and the pure interest rate is interesting, it's not very much, really. That's between 1% and 2%. So this is that risk-free interest rate at being at 1 to 2%. So the changes that are added on to this pure interest rate, the various premiums, is how we arrive at that market rate of interest. In our example, when we're talking about like an inflation premium, for example, what we're doing is we're signaling the inflation signals a change in price levels. That is a change in price levels, which also means a change in the value of the money, right? Of the value of money. If the market anticipates 6% inflation over a coming year, then it is given that the principal, the base payment, will fall by 6% if nothing changes. This is because the 6% rate of inflation means that the value of a dollar will drop by 6% over that year. So therefore, more units of money are required for a given good or service. So the inflation premium would amount to 6% tacked on to that pure interest rate between 1% and 2%. So we're looking at if we're just recognizing that inflation premium, it would be at 7 or 8%, right? There are other types of things, again, that we're looking at: financial uncertainty, credit risk or default risk, where not only are you at risk of not receiving your interest, you're also at risk of not receiving the principal being paid back. The tax treatment, and again, like with equities, the dividend is considered a normal income versus debt. Debt oftentimes is considered a deductible expense. So keep this in mind, okay? Inflation premium, we already mentioned, that's another risk. And when we talk about economic rent, producer surplus, or economic profit, that would be the usury area where we're moving beyond just our opportunity cost level of compensation, the opportunity cost level of interest, right? So the question, these are things we've already covered, but why do we pay dividends? The dividend is profit sharing, and why do we pay profits? We pay profits in order to keep that resource in place, to keep that financial capital in place, to keep that financial capital engaged within the framework of that firm, that company, etc. It's the same thing for interest. Why do we pay interest? We pay interest to cover our opportunity cost. That's again the same. So interest is paid to debt or bonds or whatever that debt instrument might be, in the same manner that dividends are paid out to shareholders. So remember, shareholders can receive compensation, if you will, one, through dividends, and secondly, they can get that through capital gains. That's the actual appreciation of their stock, but it's unrealized, and it becomes realized, of course, when they sell their stock. So in the process, the background behind this, I guess you'd say, is that we're surrendering leisure. Remember, when we are giving up when we give up our financial resources, we're giving up the leisure that could purchase. And we have to invest in that human capital in order to acquire that financial capital some way, shape, or form, unless we win the lottery. But anyway, you get the idea. Deferred consumption, meaning that you have to there are all these costs that are going into this. It starts to get very, very expensive for you to actually lend money out, and this is the reason why interest rates can climb so high. Deferred consumption. Again, would you rather spend it right now, or would you rather not spend it right now and spend it later on? Of course, all of us would rather have that bird in hand versus the bird in the bush, right? We'd rather have something known quantity and be able to exchange our financial resources for some physical capital. Sound familiar? And of course, there's always the risk that's included in this as well. And the final point again on profits as a cost. Remember, to the firm, if we're looking at the firm has to pay compensation to the productive resources. So that's a cost to the firm. So that's why we say that what's embedded in this cost is some degree, some amount of profit, some normal profit to keep them employed, if you will. And so this is a major distinction between economics and accounting, of course. So again, not to get sidetracked too much, but it's worth kind of talking a bit about accounting at this point. So this is just a primer on accounting and very, very short. So there are two major statements when we talk about accounting. One is the income statement, that's the profit and loss statement. And then there's the balance sheet, which is a statement of condition. The income statement or the profit and loss statement indicates over a period of time how much is spent and what the revenues minus expenses are over a period of time. So going from January 1 through December 31, for example, as opposed to the balance sheet or the statement of condition, and that would be a snapshot exactly where you're at so far as your assets, liabilities, and the owner's equity or the equity that's left over after at one given point in time. So again, basically what it's all about is matching cost or expenses with the revenues they generate over a period of time to determine whether or not the firm has made a profit or loss. So you're matching your expenses with those revenues, right? So if you purchase items to create revenue, will the item in question generate revenue only in this period or in future periods? If it is only for the current period, then you expense the item. So if it's just for 1 year, for example, something that's going to be used up or spent over 1 year and used up and spent in 1 year, then that would be an expense item versus if you were to buy some capital good, right? A new car for your business or a new vehicle, truck, or buy a new building. So we're generating revenues for future periods using that, whatever that asset is, whatever that item is. Then you capitalize those, that good that we're talking about, that asset that you're purchasing. So show us an asset and then estimate how much will be used up in future period. This is the depreciation piece of the puzzle. So you expense out that item over a period of time. So accordingly, the portion expensed in the future periods will be matched with the revenues it helps generates for that given period. Again, going forward, this is that estimation part that we talk about. When we split that cost over several periods, or when we alter the revenue flow from when it was received to when it was really earned, this is called accrual accounting. So it's, again, matching expenses and revenues. And if you buy a truck that's going to last 10 years and you depreciate it over a 10-year period or 5-year period, whatever that period is, then you're matching the expenses as you go along. This is your accruing expenses as you move through. So this is why when we talk about accounting, it's not an exact science, it's an art of estimation. So again, different results depend on how you choose to accrue and or defer those expenses and revenues. Significantly different profits or losses can result. This gives rise to ambiguity, and this is why we have audits and we have generally accepted principles, GAAP accounting, and the various guidelines that are put in place out there for accounting. Okay. So when we're talking about estimating, we're really looking at what we're trying to do is determine whether or not we're experiencing profit or loss is what it comes down to. So first off, over a given period of time, we're looking at that over a given period of time. That's the income statement, how it behaves from one point to another. Secondly, the value of the assets. Again, this is the balance sheet with that snapshot. And the two major sources of financing those assets: liabilities, debt, and owner's equity. So where are we getting this? How are we financing those assets? Are we financing them through debt, through liability, or are we financing with that owner's equity, that equity piece? So this is where it comes together. This is a tough part where people have a hard time kind of getting their heads wrapped around it. But if you think about it, what that balance sheet represents is that kind of the snapshot of that debt, of that financial capital of the firm. The financial capital, again, in terms of the overall assets, that's a snapshot, and its makeup being liabilities, how much is being financed by debt, and also the equity side of it, how much is actually being financed through equity, and in terms of the stockholders side of the equation. It's very simple, very powerful, hopefully that helps. It should help actually with your accounting, but it also fits within the framework of economics as well. So finance, what we're saying is that finance disaccrues or differs, and is we're moving from that accrual-based accounting back to cash. Again, in doing so, we're stripping away all of this depreciation and all these other deferrals and so on and so forth, things that we're looking forward, we're bringing them back into present. So we're pulling them back into our current time. And then what we're doing is we're projecting outward. So it's kind of a weird setup, but this is the nature of finance. It's the takeaway is that the longer the view, so far as like a forecast is concerned, the less likely that what you're guessing, what you're forecasting is actually going to come to pass in that manner. Okay, and it's like guessing about the weather. We know that there's going to be rain coming. It's a matter of when, hopefully. Anyway, not too much, but hopefully. So discounted cash flows, moving from accrual again back to the cash base. Also in finance, all dollars of cash flows are not the same value. This is referred to again as a time value of money. The further away in time, the lower the discounted present value of a dollar. The closer in time, the higher the discounted present value of the dollar. Meaning that the closer you are actually to the actual money that you would have had in your possession otherwise. So these units of measure will occur in income statements and in balance sheets. So it's going to be reflected in both of the financial statements. Onward. So a departure from the last, we're looking at compensation, unions, etc., rewards for productive resources, that income, the compensation to labor, profits, interest based on the worth of the firm. The more competitive the firm, the more competitive that market, the more competitive that structure, the market structure that they're in, the less economic rent there's going to be, the less that's going to be paid out in terms of any kind of excess profit, any kind of economic rent. So unions, through market power, garner economic rent. They're able to take some of that producer surplus, that economic rent, that excess profit, if you will. And oftentimes it's not just the labor that's getting excess compensation, it would be the other productive resources as well. So kind of keep that in mind. So as markets become more and more competitive, this reduces that economic rent. So the unions this is again why unions are not prevalent in fast food restaurants, for example. There's just not enough meat on the bone, okay? So economic rent, again, if the firm has market power, it can reduce supply, and we've been through this before, but they can increase prices and therefore increase profits. Some of those profits can be bid away in the form of higher wages, interest, other payments to the productive resources, right? And this is again, economic rent is also called producer surplus. The producer being that labor, entrepreneurship, capital, and land or land, any combination thereof, are getting more than their opportunity cost level of compensation. They're receiving economic rent, producer surplus, and they're receiving more than their just desserts. Competition is the antidote. And why it's so important is, again, that on the other side, so it's not just on the equity side, in terms of the productive resources earning their opportunity cost level of compensation, no more, no less, that ensures efficiency on the other side. So you cannot have efficiency, you cannot have efficient markets unless you meet the equity criteria. You might have relatively efficient markets, but there's no way you can maximize the consumer surplus, et cetera, without having that competition in place. Okay, you need to have that in order for markets to be efficient. So also remember, as competition increases, this pushes prices downward, and again reducing that economic rent for resources because it's driving prices. But downward, it increases consumer surplus and thus decreases economic rent awarded to those resources. So this is that exchange between equity and efficiency. But first, you have to have equity. Keep that in mind. So we've already been through this before, but let's walk through the kind of recapping what we covered in the chapter. So why do we pay dividends? So in spite of the fact that some might argue against it, the equity capitalist must be compensated for its risk or the equity capitalist will leave. All of us understand this, whether we're talking about dividends or if we're talking about if we're looking at, in terms of dividends, or if we're looking at it in terms of capital gain, there's the expectation of some compensation to cover the opportunity cost, enough compensation to cover the opportunity cost. So why do we pay interest? Same reason. Why do we pay interest on debt capital? The underlying question is how the capitalist, equity or debt, get the financial capital to invest in the first place. You have to defer that. You defer your own expenditures, right? So first, using the bondholder, for example, they first again have to give up the leisure. They have to surrender leisure. They probably had to embody more capital, human capital that is, some form of schooling, complete training, or attending conferences or something, right, in order to acquire that additional financial capital in the form of money, if you will. They have to defer the consumption of real goods and services. That's what those dollars, if you will, are able to purchase. Take on uncertainty as they acquire the funds. Again, even with debt capital, you're not always certain about the interest will be paid. Equity capitalists, you're not assured that the firm will earn enough or any profits, let alone any dividend or capital gain for that matter. So this is where that risk part really comes into play. And finally, again, you have to abstain from current consumption. If we had our choice, we would almost always prefer to spend every dime that we have. Many people do, but that's where that opportunity cost comes into play. Interest, profits, and labor compensation are all costs to the firm. Think about it. If the reward exceeds opportunity cost, then the income that the resources receive include an element of surplus interest, surplus profit, or surplus labor compensation, and this all equates with what? Economic rent or producer surplus.